Okay, so we talked about growth, we talked about unemployment. Um, Inflation is one of those things that if you haven't, if you come across it outside of economics, it's been explained to you in a very misleading fashion. Everybody always says that inflation means that somehow money is losing its value or something, and everybody therefore thinks that the only way in which inflation happens is if governments print too much money or something stupid like that. Inflation is dead simple. Inflation really it's a process of sustained rising prices, and that's it. It just means that prices are rising over time, in a sustained sort of way, and hence money is losing its value because if you got a £10 note, then tomorrow it'll buy you fewer things than it does today. But the key, is that we have rising prices. Prices rising in a sustained fashion over time. Now, how therefore do we measure inflation? Inflation is measured using a represented basket of goods and services, and that changes over time to reflect the fact that we need to take out rabbit, because nobody eats it anymore, and put in, coffee pods or something. And the one that's used most often in the UK is a basket, based. The measure used is used to construct an index called the Consumer Prices Index, or CPI. And the Bank of England uses that as its inflation target. So in the UK, the Bank of England has been given control over inflation. It's always been told to control inflation. And the Bank of England, the BOE, has a target, therefore, of 2% inflation, as measured by CPI, plus or minus 1%. So that's a symmetrical target. So hence, 1% inflation is as bad as 3% inflation. And the reason is that whilst we don't want prices rising too fast, countries like Japan have seen that there is a danger that if prices are falling all the time, you can get caught in a trap. Whereby because prices are falling, people don't want to spend because they realise that prices will be even lower in the future. Because they don't want to spend, that means that firms have no demand. Therefore, they fire people. Demand falls further, and you get caught in this deflationary trap. So that's your framework. It's measured by basket goods and services. In the UK, the target is about 2%. We don't want inflation too high, but nor do we want it too low. And we'll come back to this in more detail later. This is just kind of an outline. So why does inflation happen? You kind of know this from microeconomics. You know that why prices can rise. There can be, on the one hand, issues related to costs. So on the one hand, we have what's called cost push inflation. So if there is a sudden increase in wages in an economy, or there is a sudden increase in oil prices, or other commodities, or suppose there was a big decrease in exchange rate, the value of the currency, then the price of everything that you buy from abroad, is going to be more expensive. Hence, the costs of businesses go up. Or it might be, say, an increase in VAT. The point about so indirect taxes. The point about all of these things is that they increase firms' costs. Because firms' costs are higher, if they're going to continue to make a profit, that forces them to increase prices to sustain their overall profitability. So one reason that prices are rising, is that businesses are forced to. And a good way of trying to think about inflation is what I call the restaurant economy. So why might a restaurant increase its prices? Firstly, it might increase its prices, because it's facing rising costs. The other reason is that it might just have too much demand. So there might be demand pull inflation. And this is associated with a rapid increase in total demand. I'm going to call that AD, aggregate demand in the economy. What that means is that, therefore, actually when there's lots of demand in the economy, there is a decrease in competition between firms. Everybody has as many customers as they need. We're booked up till next Christmas. So therefore it's easy for firms to increase their prices. And they may have to do so because when demand is rising, what also happens is that there can be shortages of factors of production, particularly workers. So as demand is rising, lots of firms are employing new workers. Therefore, if you want workers, you may find it difficult to get them. You may have to offer higher wages to attract workers, or even just to keep your current workers. Again, so that then, there's an interplay, between demand pull and cost push inflation. So rising demand reduces competition between firms, makes it easier for you to increase your prices, and you may have to, because your costs may be rising. And then there's pure cost push inflation, where there's some sort of shock in the economy, which leads to an overall increase in your cost base, meaning that you have to increase prices. So that's where inflation originates from. But if you look at, again, if you go to trading economics and look at inflation for the vast majority of countries, you'll see that there always seems to be inflation. So what that seems to suggest is that there's forces that sustain inflation. And one of the most useful models that you'll find when trying to understand inflation is what's called the wage price spiral. And this explains, you can use it both to see where inflation comes from, but more importantly, how it's sustained. It doesn't really matter where you start off, but on one side we'll have, say, over here we'll have labour markets. So in the labour market, what happens is that wages are set. Over here, we'll have product markets. So obviously that's the market for products. So that's where firms compete, and that's where prices are set. And let's suppose that there is some shock that forces firms to increase their prices. As a result of that, what happens is that the cost of living for households starts to increase. Because the cost of living increases, then households demand higher wages from the firms that they work for. Because the increase in the price level increase their cost of living, their real wages reduce, their wages buy fewer things. As a result of wages increasing, what happens is that the cost of production for firms increases. And because the cost of production has increased, firms need to increase prices. And once this process has been established for long enough, what starts to happen is that you also get inflationary expectations. And when inflationary expectations start to come about, both firms and workers are expecting price increases, and they factor that into the way in which they operate. And this is a really helpful model, because you can see that once inflation has begun, it's quite hard to get rid of. Once I expect an increase in prices, then I'm going to ask for an increase in wages. When I get an increase in wages, that creates the inflation that I expected. And this is, when you come to look at how to get rid of inflation, which we will eventually, trying to kind of weaken this wage price spiral is going to be quite important. Okay, so finally, why do we care about inflation? And the answer is, the answer is quite complicated, but for now we'll keep it relatively straightforward. If we say, so what we're saying is, well, firstly, obviously, it damages people who have fixed incomes or savings. So savers lose. Anybody with a fixed income loses. So this tends often to be pensioners. So old people. People on the minimum wage or with no negotiating power, they may lose because they may not be able to negotiate an increase in wages. So in real terms, they lose out. Secondly, it's likely to damage your international competitiveness. It's going to make it much harder if inflation is rapid. UK prices are increasing. That makes it difficult for firms to compete on world markets because British prices are rising faster than those in Germany or the States. Thirdly, rapid inflation creates, it suggests that the economy is unstable. Businesses and individuals, consumers are going to be worried. And these instabilities, what they do is they decrease confidence. And what that means is it's much less likely that there will be investment by firms. And we said before that investment is quite important for creating long-term growth. Yeah, so that's a problem as well. And specifically, if you have cost-push inflation, that directly can trigger a recession. And the reason is that if there is a sudden increase in something like oil prices, firms have to increase so because their costs increase, firms have to increase their prices, as a result of which consumers can't afford to buy things anymore, demand falls, and then employment's likely to rise. There's more to it than this, quite a bit more, and we'll come to that later in the course. But for now, inflation damages people's savings. It hurts low-income groups like pensioners and those on insecure jobs. It damages international competitiveness and is bad for overall confidence.